You open a checking account on a Tuesday afternoon, and the banker across the desk tells you with a genuine, practiced smile that it's completely free. No monthly fee, no minimum balance. Free checks, a free debit card, free online banking. You sign the paperwork and walk out with a new account number and the specific, satisfied feeling of having gotten something for nothing. It is not free. It was never free. You simply cannot see who's paying or how much, and that invisibility is not an accident. It is the entire business model. The average American bank customer generates somewhere between $300 and $500 a year in profit for their bank, and almost none of it comes from a line item you'd recognize as a fee. It comes from mechanisms so quietly built into the ordinary experience of having a bank account that you could go your entire life without ever noticing them operating. Mechanisms with names like the spread, the float, and the overdraft waterfall, each one small enough to feel invisible and reliable enough, multiplied across 200 million account holders to build glass towers in every major city in the country. This is how they actually make the money. Not from the fee they show you, from the for they don't. Act 1. The spread. You have $4,200 sitting in your checking account. The bank pays you 0.01% annual interest on it, which works out to about 42 cents a year, an amount so small the bank doesn't even bother printing it clearly on your statement most months. You have never questioned this number because 42 cents on a checking account has always felt like the natural, unremarkable order of things. Checking accounts don't pay interest. Everyone knows that. Here is what almost nobody explains clearly. Your $4,200 does not sit in a vault. The moment it lands in your account, the bank is legally permitted and functionally required by its own business model to lend a significant portion of it back out as a car loan, a mortgage, a business line of credit, a credit card balance carried by someone 3 states away who has never heard your name and never will. The bank lends your $4,200 and thousands of other customers' deposits pooled alongside it at rates between 6% and 24%, depending on the product. They are paying you 0.01% for the privilege of holding your money and charging someone else 20, 30, sometimes 40 times that rate for the privilege of using it. This gap, the difference between what a bank pays depositors and what it charges borrowers, is called the spread, and it is the single largest source of profit in the entire banking industry, larger than every fee combined, and it requires you to do absolutely nothing except leave your money where it already is. You are not being robbed in any way the law would recognize. Every part of this is disclosed, technically, in documents nobody reads. But you are participating, without having agreed to anything you'd recognize as an agreement, in a business where your patience and inattention is the actual raw material being converted into profit. The first rule: every dollar sitting in a traditional checking or savings account earning near zero interest is a dollar actively subsidizing the bank's most profitable business line, and the bank has no incentive whatsoever to explain this to you clearly, because the entire system depends on most people never asking the question you're asking right now. Act 2. The float. You deposit a $1,800 check on a Friday afternoon. The app shows the deposit immediately, a satisfying instant confirmation. Your balance updated right there on the screen. But if you look closely, in text small enough that most people scroll past it without reading, there's a note. Funds may not be available for withdrawal for up to 5 business days. This gap between when the bank shows you the money and when you can actually use it is called the float, and it exists for reasons the bank will describe, accurately but incompletely, as fraud prevention. What they will not volunteer is that during those 5 days, your $1,800 is not simply sitting untouched, waiting politely for the hold to clear. It has already entered the bank's lending pool. It is already functionally earning the bank money, while you, the person who actually owns it, are locked out of using it for anything at all. Multiply this by every check deposited, every paycheck processed, every transfer initiated across every customer at a mid-size regional bank, and the float represents tens of millions of dollars on any given day that the bank is actively using and profiting from while customers wait for access to money that is, on paper, already theirs. You learn this specifically on a Tuesday when your rent is due and your paycheck deposited the previous Friday is still showing as pending 3 business days later. You call the bank. The representative is polite, apologetic, and completely unable to expedite anything because the delay is not a malfunction. It is the system working exactly as designed. Act 3. The overdraft waterfall. Your account has $34.50 in it on a Thursday morning. You make 3 small purchases that day: coffee for $4.75, gas for $22, and a $9 lunch totaling $35.75, which is $1.25 more than what's in your account. In a fair, simple system, this would trigger 1 overdraft, 1 fee, a clear and proportionate consequence for a clear and proportionate mistake. This is not what happens. Most major banks, for decades, employed a specific and quietly devastating practice called transaction reordering. Instead of processing your day's purchases in the order you actually made them, the bank system reorders them from largest to smallest before calculating overdrafts. Your $22 gas purchase gets processed first, dropping your balance to $12.50. Then your $9 lunch, dropping it to $3.50. Then your $4.75 coffee, the smallest purchase, the one that actually pushed you over, triggers the overdraft at a fee of $35. But because the reordering pushed your balance negative earlier than a chronological ordering would have, some of your other transactions that day now also register as overdrafts, each carrying its own $35 fee. What should have been one $35 charge for a $1.25 mistake becomes $105 or more, engineered not by your spending, but by the specific, deliberate order in which the bank chose to process purchases you'd already made. Class action lawsuits throughout the 2010s forced many major banks to abandon the most aggressive versions of this practice, and disclosure requirements have improved. But overdraft fees still generate over $12 billion annually across the American banking industry, disproportionately extracted from customers living closest to the edge of their balance. The customers who, by definition, can least afford to lose $35, let alone $105, to a fee triggered by a 1.25 gap. Act 4. The minimum payment trap. You carry a credit card balance of $3,400 at 22.9% APR. You make the minimum payment every month, $85, which feels reasonably like you're handling the debt responsibly. You are making the payment. The balance is not growing out of control. From where you're sitting, this looks like a manageable situation. Here is what the minimum payment is actually structured to do. At $85 a month against a $3,400 balance at 22.9% interest, approximately $65 of your payment goes directly to interest and only $20 actually reduces what you owe. At this rate, paying only the minimum, it will take you 11 years and 4 months to pay off the balance, and you will pay a total of $4,847 in interest alone, more than the original $3,400 you borrowed. This is not an accident of math the bank apologizes for. The minimum payment amount is calculated specifically to be low enough that you can afford it without much strain, and high enough to feel like real progress, while remaining structured to keep the balance active and accruing interest for as long as legally and practically possible. A credit card company does not want you to pay off your balance quickly. A customer who carries a balance for 11 years is worth vastly more than a customer who pays it off in 11 months. You do not learn this until you sit down on an unremarkable Sunday evening and actually calculate what 11 years of $85 payments adds up to. A moment that changes permanently how you look at every minimum payment reminder that arrives afterward. Act 5. What you are worth beyond your money. You use your debit card 16 times this month. Coffee, groceries, gas, a subscription renewal, a restaurant, a hardware store, a pharmacy, an ordinary month, unremarkable in every way you'd notice living it. But each of these 16 transactions is logged, categorized, and analyzed by systems built specifically to construct a detailed behavioral profile of exactly the kind of customer you are, what you're likely to need next, and what financial products you can be efficiently sold. Your bank knows, with a precision that would unsettle you if you saw it laid out plainly, that customers who spend at hardware stores and pharmacies in the same month are statistically more likely to be homeowners managing an aging house and an aging family member simultaneously, a profile that correlates strongly with receptiveness to home equity line of credit offers, which is why 3 weeks later, you receive an email offering exactly that product, timed and worded with a precision that feels uncomfortably like the bank knows something about your life it was never told directly. It didn't need to be. The purchase data itself is the disclosure, and you agreed to it, technically, buried in paragraph 41 of a terms of service document you scrolled past and accepted in under 4 seconds in order to open the account in the first place. This data, anonymized, aggregated, and sold to marketing partners or used internally to target you with cross-sold products, represents a second, quieter revenue stream running parallel to the spread, the float, and the fees. You are not just a depositor whose patience subsidizes lending profit. You are also a dataset, continuously generating insight that gets monetized whether or not you ever overdraft, ever carry a balance, or ever pay a single fee in your life. Act 6. What actually changes the math? You move $4,200 out of your checking account and into a high-yield savings account paying 4.5% annually. The transfer takes 11 minutes. Your checking account, which was earning you 42 cents a year, no longer holds the money at all. It holds only what you need for near-term spending, moved automatically each month to cover bills. The $4,200 sitting instead in an account explicitly built to compete for it now earns $189 a year instead of 42 cents, doing nothing differently except existing in a system designed to pay you closer to what your money is actually worth to whoever ends up lending it out. You call your credit card company and, using a script you found from a consumer advocacy site, ask directly for a lower interest rate, citing your payment history and a competing offer from another card. The representative, following a process that exists specifically for this exact conversation, lowers your rate from 22.9% to 16.9% in under 6 minutes. This single call, repeated once a year, will save you over $2,000 in interest across the life of your average carried balance. You set a calendar reminder to pay off your credit card in full every month, converting the minimum payment trap into a non-event, an account that generates no interest revenue for the issuing bank at all, because you have simply removed yourself from the pool of customers the entire minimum payment structure was built to extract from. None of this requires more income. None of it requires financial sophistication beyond understanding the 4 mechanisms this video just walked through. It requires only the specific uncomfortable knowledge that the free checking account was never free, the deposit hold was never purely about fraud, the overdraft fee was never simply a penalty, and the friendly cross-sell email was never a coincidence. And the willingness, once you understand this, to stop being the raw material and start being the customer who asks the questions the system was built to discourage. The 6th rule, you do not need to leave the banking system to stop subsidizing it. You need to understand precisely which of its ordinary, everyday mechanisms are quietly extracting value from you and redirect your money, your attention, and your patience toward the versions of these same products that were built to compete for your business, instead of simply assuming they already had it. Somewhere tonight, someone is opening a checking account, and a banker across a desk is telling them, with a genuine, practiced smile, that it's completely free. They will believe it, the same way you believed it, because there is no line item on the paperwork that says otherwise, no fee schedule that lists the spread, or the float, or your purchasing behavior as a cost of the account. The absence of a visible price is not the same thing as the absence of a price. It simply means the price is being paid in a currency you were never taught to recognize. Your patience, your inattention, your near-zero interest, your data, your 11 years of minimum payments on a debt that could have been closed in 3. This is not a call to distrust every bank or abandon the banking system entirely. Banks provide a genuinely necessary service, and the mechanisms described in this video are, in most cases, legal, disclosed, and standard practice across the entire industry. The problem was never that banks make money. The problem is that most people have no idea how, which means they have no ability to negotiate, redirect, or opt out of the specific mechanisms extracting the most value from their specific situation. Move the money that's sitting idle. Ask for the lower rate. pay the statement in full. Read paragraph 41 at least once, just to know what you agreed to. The account will still say free. You will simply understand for the first time exactly what that word was always quietly asking you to pay. Subscribe so you don't miss the next one.